Britain's housing mortgage market's in meltdown, and estate agent Jaspal Saini fears for his business. The government's plan for sweeping tax cuts and huge amounts of borrowing spooked investors, forcing dozens of lenders to pull hundreds of mortgage deals.
Buyers are understandably quite anxious about what's going to happen next. I think the key thing we've got to remember is buyers are also sellers. We're seeing a lower level of buyers coming to the markets. We've had a 40% reduction in buyers actually registering who've got mortgages approved in principle. And this is even, I think this trend's going to continue just with obviously suspension of certain mortgage products.
While buyers and sellers reevaluate their options, the International Monetary Fund, the lender of last resort, urged the British government to reconsider cutting taxes at a time of soaring inflation. The IMF fears it will spark a global slowdown and risks widening inequality, the kind of warning the IMF gives to emerging economies, not the UK. Last Friday, the Chancellor of the Exchequer announced a bonanza of tax cuts and debt-funded spending in the hopes of stimulating economic growth. But the move has spectacularly backfired, the value of the pound plummeting to its lowest level since 1985.
The whole market is in turmoil at the moment, and people are waiting for some conciliatory tones from either the Chancellor or the Bank of England to actually settle the markets down, and at the moment that hasn't been forthcoming.
The figures forced the Bank of England on Wednesday to take evasive action and buy government bonds on a temporary basis to help calm the market. But within minutes, the pound fell again, down 1.6% against the dollar. As the pound falls, the cost of government borrowing on the international bond markets has gone up from an interest rate of around 1.5% to 2.5% to 5%, seemingly overnight, expressing a real lack of confidence from investors about the government's ability to pay for its own plans. UK debt is now seen by investors as being similar to Greece or Italy, countries with long histories of economic mismanagement. Even before all this, inflation, the gradual increase in the price of goods over a year, was around 10%, its highest in 40 years and the highest amongst G7 advanced economies. A perfect storm of factors, including the war in Ukraine, have disrupted supplies of goods such as oil, wheat and fertiliser, pushing up the price of food, fuel and other items. And in order to dampen those rises, the Bank of England, that acts independently of the government, has raised interest rates, the cost of borrowing, to slow down spending and keep prices under control. But the turbulent pound means only one thing: the Bank of England responding with even higher rates of interest to help steady prices. The heads of some of the world's leading banks were summoned to the Treasury to try to restore confidence in the government's plans. But politically, things are anything but stable. There's disquiet amongst MPs from the governing Conservative Party, some reportedly calling for Liz Truss's premiership to end before it's really begun. Neve Barker, Al Jazeera, London.